Fitch projects Cedi stability through 2026 and warns of risk from falling gold prices and debt discipline crucial to ending IMF dependence, governance group warns. And also Ghana's petroleum revenues plunge 56% in first half of 2025. Now let's settle for the details of the story. Fitch Solutions has projected that the recent strong performance of the Ghana cedi will be sustained through 2025 and 2026. According to the UK-based research firm, the cedi's outlook is supported by the Bank of Ghana's solid international reserves, currently at $7.9 billion and high global gold prices, which continue to boost export earnings. In its latest report titled What Our Clients Want to Know, Sub-Saharan Africa Q3 2025 Macroeconomic Update, Fitch cautioned, however, that a sharp decline in gold prices could undermine this positive trend. Fitch noted that the central bank would struggle to defend the cedi and would likely be forced to allow the currency to depreciate. Now, away from that, the Economic Governance Platform is calling for urgent reform in Ghana's debt management practices to help the country break its recurring cycle of International Monetary Fund bailout. Coordinator of the platform, Abdul Karim Mohammed, speaking during an anti-corruption event in Kumasi, stressed that sustainable debt management is essential for long-term economic independence. He cited poor fiscal discipline, corruption, sourcing of contract, and mismanagement of public funds as key factors behind Ghana's mounting debt and financial instability. At a related forum organized by the Ghana Anti-Corruption Coalition, stakeholders examined the political, institutional, and transparency challenges contributing to the country's debt crisis. The coalition's findings focused on three core issues: how political interests drive unsustainable borrowing, the effectiveness of debt management systems, and the urgent need for debt transparency. The group is urging policymakers to strengthen domestic revenue mobilization, control public spending, and adopt transparent borrowing practices to ensure economic resilience. Now, Ghana's petroleum revenues have dropped sharply by 56% in the first half of 2025, falling to $370.6 million compared to $840.8 million during the same period last year. The latest data from the Bank of Ghana points to a significant decline in crude oil production and lower global oil prices as key drivers of the slump. The Ghana Group lifted just 2.81 million barrels in the first half of the year, down from 3.77 million barrels in 2024, while average crude prices also declined from $84 per barrel to $75. The revenue drop follows a strong 2024 performance where petroleum receipts hit $1.36 billion, the second highest in the nation's history. However, the underlying trend has been less optimistic, with production steadily falling since peaking in 2019. The situation worsened this year due to operational disruptions, including a 14-day production shutdown in March and April. Sector experts say this further strained output and government revenues. Meanwhile, no new petroleum agreements have been signed since 2018, raising concerns about the long-term sustainability of Ghana's oil sector. Civil society groups like ACEP warn that without renewed exploration and investment, the country could face continued production declines and revenue volatility. Analysts say the government's ability to fund key development projects may now be constrained as hopes shift toward a recovery in output during the second half of the year. Now, the government's latest Treasury Bill auction has seen strong investor demand with an oversubscription rate of 42.07%. According to figures from the Bank of Ghana, while the target was to raise 3.86 billion Ghana cedis, total bids reached 5.48 billion Ghana cedis. Out of 4.86 billion Ghana cedis in bids for the 91-day bill, 4.32 billion Ghana cedis was accepted. For the 182-day bill, 823 million Ghana cedis was accepted from 1.15 billion Ghana cedis in bid. Meanwhile, 343 million Ghana cedis was secured from 774 million Ghana cedis in bid for the 364-day bill. Analysts say the sustained investor appetite is due to expectations of falling interest and inflation rate, prompting institutions to lock in current yield. And despite high demand, yields on short-term bills continue to decline. The 91-day rate dropped to 10.29%, the 182-day to 12.35%, and the 364-day to 13.24%. The government is now targeting 8.58 billion Ghana cedis in its next auction.